Is a global recession inevitable? Let's have a look. Good morning everyone, Florian Heise here and welcome to another episode of Heise Says. Here with my trusty stein of coffee, and I thought today we would look at the question of whether is a global recession inevitable. And this is an article from news.com and it's discussing the inverse curve, the 10-2 spread from different bond yields. Now, there's a fair few things to discuss here, and let's just jump right in, because Trump in the States is making some unusual tweets and is trying to pump everything up, which is what he does. You know, he's a marketing guy, essentially a brander. So, crazy inverted yield curve. Trump weighs in as Dow slumps 800 points after bonds flash recession warning. Okay. So US President Donald Trump has lashed out on Twitter to defend his economic policies after a crazy recession warning light flashed red, sparking a bloodbath on Wall Street as investors braced for a global crash. Now, I would imagine a lot of people watching this channel are suspecting there will be a global crash, that a recession is inevitable. What are you doing to prepare for that? You know, how are you hedging? What are your strategies? The yield on the closely watched 10-year Treasury fell so low Wednesday that for the first time since 2007, it briefly crossed a threshold that has correctly predicted many past recessions. Weak economic data from Germany and China added to recent signs of a global slowdown. Well, we're seeing that everywhere. We're seeing that everywhere. And, I mean, let's have a look a little bit about this curve, the spread between the 2-year note and the 10-year note, because these are to do with bonds. Now, before we look at this, let's jump quickly to Investopia to explain what a bond yield is, to explain what one is, just briefly. And I'll link to all of this if you want to go into any detail, but this is for people who may not be familiar with it. And I know some of you are probably experts in this and can explain it a lot better. So what is a bond yield? Bond yield is the return an investor realizes on a bond. Okay, that sounds pretty simple. The bond yield can be defined in different ways. Setting the bond yield equal to its coupon rate is the simplest definition. So this is where, say, you buy a bond for a certain amount and you get a 4% return per annum. You'll be paid for a certain period of time. I think QIC here in Queensland recently issued a bond, because this is a private bond as opposed to a government one. They use it to get money to invest in upgrading their air conditioning systems and plants in different major shopping centers for environmental benefits. So it was a green bond. And apparently it sold out to institutional investors like that really quick, which I thought was quite interesting. So the current yield is a function of the bond's price and its coupon or interest payment, which may be more accurate than the coupon yield if the price of the bond is different than its face value. So here's the thing. Your bond could have a particular price, say $100, but what it's traded for adjusts in the free market. So there can be a difference. And the current yield is what, taking that into account. So more complex calculations of a bond yield will account for time value of money and compounding interest payments. These calculations include yield to maturity, bond equivalent yield, effective annual yield. Okay, but that's enough to give us an overview of just what it is and an understanding. I mean, they've got greater detail here, and you can look at that on your own time. And I'll link to this, but we know what a bond yield is. I think the coupon rate, sure, we're all familiar with. Then the current yield is, going to be the coupon rate adjusted for the value of the bond, what it's trading for. So we'll jump back here to 5 things investors. This is from MarketWatch. 5 things investors need to know about an inverted yield curve. So we can see here the last time it happened was in 2007, and look how significant that was. What happened in 2008? Can someone refresh my memory? GFC. The GFC. Look how it shot back up. And look how we've been heading. Here we go. Once again. So the main measure of the yield curve briefly inverted Wednesday, with the yield on the 10-year Treasury note falling below the yield on the 2-year note, and rattled stocks and other markets by underlining investors worried over a potential recession. But while inversions are seen as a reliable recession indicator, investors may be pushing the panic button prematurely. Here's a look at what happened, and what it might mean for financial markets. So what's the yield curve? Okay. The yield curve is a line plotting out yields across maturities. Typically, it slopes upwards, with investors demanding more compensation to hold a note or bond for a longer period, given the risk of inflation and other uncertainties. That makes complete sense. That makes complete sense, doesn't it? An inverted curve can be a source of concern for a variety of reasons. Short-term rates could be running high because overly tight monetary policy is slowing the economy, or it could be that investor worries about future economic growth are stoking demand for safe long-term treasuries, pushing down long-term rates. So let's jump onto the surface and we'll do some diagramming to get a little bit of an understanding of what's happening here. Now, say we have a bond. This is our bond. It's worth $1,000. That's the face value of the bond. Okay, and it pays each year interest or 10% or a payment of 10%. So it's paying you $100. So you buy this bond. Fantastic. You're getting 10% a year. So you're happy. That's great. But let's say interest rates rise above 10%. They rise above 10%. And let's say they go to 12.5% in the market. Okay? So that you could take your $1,000 and you could buy a bond for $1,000, that old one, or there's new ones on the market, or new investment strategies where your $1,000 will earn you $125 per year. So that is a more attractive investment. So you would be crazy to pay the same money for less return, wouldn't you? So the original bond is still only making a payment of $100 a year, and now investors can find other products. But say you want to sell this bond. Okay, say you want to sell your bond. What you'd have to do is the price of this bond on the market would adjust. Now, the face value, that stays the same. That doesn't adjust, but the market value of the bond would drop. So it would take account of the 12% interest rate or 12.5% interest rate, and would say, looking at an example here, about $927 or $930 to adjust. So that is the market price for this bond. So we bought a bond here for $1,000, and because of interest rate changes going down, the market value of that bond, interest rates going up, the market value of the bond has changed. So we'll just say, for really simple, for $930. So the price is adjusted. So you've got the coupon price, you've got the money that you get from that bond, regardless of what you pay for it, you'll still get that. So that'll make it more attractive. But let's say interest rates don't go up. Let's say interest rates go down, and we'll use a simple example here of a $1,000 bond, and it's still paying you $100. That's your yield. That's what you're getting. But say the interest rates have adjusted, and now it's 7.5%. Okay, 7.5%. So that means this bond is going to look really attractive, because everything else where you put your $1,000 in, say, term deposit or something, you're only going to get $75. So that's a big difference in your ROI, isn't it? So the price of this bond, remember the face value isn't changing, but the market value of it will go up. It'll go up. So, say over $100. So 101 would say. It's the example I'm looking at. What am I doing? 1,101.15. So it's gone up in value. So the market price of this bond has gone up because of interest rates. Okay, and remember, this is also to do with time frames as well. So if you've got a 2-year bond and you're planning for this future, as opposed to, a 30-year bond, just think of all of the stupid things that can happen around the world that can influence your price. Over 30 years, what are the chances of interest rate changes occurring? So that should be factored into the value of the bond, or how much you're willing to pay, or the return, the coupon price, the yield that you should get from the bond. Okay, so that's my attempts to understand what's going on here, because what we're seeing in the market, and I mean, here's some examples: bond yields around the world. I mean, have a look at this. You're getting bond yields, interest rates around the world. Have a look at all the negatives. Have a look at this. For bonds, for 30 years. Hold on to my money. Oh, wait, I'll scroll over, you can't see it. Hold on to my money for 30 years, and I'll lose money on it. I'll lose money on it. So I'm trying to wrap my head around why people would do that. Why people would do that. And I suspect it's because some institutional investors may need to invest in bonds, or because of concern for the future, and that ties into this growing fear of a global recession, another GFC, another big issue like 2007, 2008. So let's jump back to this article. And if you can explain it better, please do in the comments, guys. If you have an explanation as to why people are investing in these negative returning investments. Is it fear? Is it legal requirements? Is it just uncertainty for the future? Let me know, because I'm trying to figure it out. I'm trying to understand why you would do that. The only thing I can think of is people that have got very little certainty for the future. So what's just happened? The yield curve has been flattened for some time. On Wednesday, a global bond rally in the wake of weak China and German economic data pulled down yields for long-term bonds. The 10-year Treasury note yield, and I'm not going to pronounce that, fell as low as 1.574, briefly trading around 1 basis point below the yield on a 2-year note. Well, there you go. The inversion was short-lived. Okay. So why does it matter? The 2-year, 10-year version of the yield curve has preceded each of the past 7 recessions, including the most recent slowdown between 2007 and 2009. Other yield curve measures have inverted, including the widely watched 3-month 10-year spread used by the Federal Reserve to gauge recession probabilities. While we don't know how long the 210 curve will remain inverted, we do know is almost everything is upsetting the markets these days, and this inversion is pushing many to the brink of losing what was deeply rooted optimism for economic growth and equity prices, says Kevin Gaitis, head of fixed income at Raymond James, in a Wednesday note. Is recession imminent? A recession isn't a certainty. Some economists have argued that the aftermath of quantitative easing measures that saw global central banks snap up government bonds and drive down long-term yields may have robbed inversion of their reliability as a predictor. According to this school of thought, negative bond yields in Europe and Japan have forced yield-starved investors to the US, artificially depressing long-term treasury yield. Okay, so because we're seeing all of these just insane, worthless or negative returns, people are being driven to the United States. That makes a lot of sense. I mean, if in a free market, if you have the capacity to, and the wealthy people and institutions have the capacity to move their money around, where will they be attracted? So some Fed policymakers, including New York Fed President John Williams, has also periodically questioned the overwhelming importance placed by market participants on the yield curve. seeing it as only one measure among many that could point to economic distress. Others say an inversion of the yield curve reflects when the bond market is expecting the US central bank to set off an extended easing cycle. This pent-up anticipation drives long-term bond yields below their short-term peers, but if the Fed cuts rates in a speedy fashion and successfully prevents an economic downturn, the yield curve's inversion this time around may turn out to be a false positive. And even if the yield curve does point to a future recession, investors might not want to panic immediately. From 1956, past recessions have started on average around 15 months after the inversion of the 2 10-year spread occurred, according to Bank of America, Merrill Lynch. So we may have time. Maybe that's it. We've got a 15-month countdown starting from when this inversion occurred. So is the stock sell-off overdone? The inversion was blamed by analysts for accelerating a stock market sell-off on Wednesday, with the Dow Jones Industrial Average ending around 800 points lower, down 3%, while the S&P 500 dropped 2.9%, and the Nasdaq declined 3%. But some investors argue that until other recession indicators such as the unemployment rate start blinking red, it's probably premature to press the panic button. Well, see, that's the thing. That's where I'd be critical. If other nations are using the same methodology to determine unemployment as the ABS is, what about the gig economy? What about the 1 hour driving an Uber, meaning that you're still employed? You know, the world has changed a lot in the decade since 2008. And my understanding is Uber's reached an all-time low. The underlying fundamentals of the economy are reasonably sound. We keep hearing that, don't we? The balance sheets of the household, non-financial and financial sectors are generally in good shape, and financial conditions are not overly restrictive, wrote Jay Brayson, an economist at Wells Fargo Securities. So there you go. That gives us an understanding a bit more about the inversion curve that's occurred, that we've hit right again. So, you know, appreciation of bonds, we've got the negative yields, we've got the theory of why this may have occurred here in the States because of just the negative returns here and money flooding into the States because of it. So let's jump back here to look at the response from Trump and what's happening in America. Do you think that that's a solid argument that people are snapping up treasury bonds in the States because of the terrible returns in Europe? Let me know in the comments, guys. So that spooked investors, who responded by dumping stocks, sending the Dow Jones to an 800-pound skid, its biggest drop of the year we've read about this. Investors have been plowing money into the safety of US government bonds for months amid growing anxiety and weakness in the global economy could sap growth in the US. Uncertainty about the outcome of the US trade war with China has spurred a return of volatility to the stock market in August. The Dow has dropped more than 5% and the S&P 500 is down more than 4%. Economic data from two of the world's biggest economies added to investors' fears on Wednesday. European markets fell after Germany's economic contracted 0.1% in the spring due to the global trade war and troubles in the auto industry. In China, the world's second largest economy, growth in factory output, retail spending and investment weakened in July. The bad news for global economies is stacking up much faster than most economists thought, so trying to keep up is exhausting. Kevin Giddas, head of fixed income capital markets at Raymond James, wrote in a report. So we're seeing a different quote from him here to what we got in the other article. The S&P fell 500, we've read all of that. The Australian share market is expected to follow Wall Street with major falls. At 7 a.m, the SPI 200 futures contract were down 131 points, or 2%, at 6,404, suggesting an early slump for the benchmark ASX 200 on Thursday. The Aussie dollar is buying 67.47 cents, down from 67.82 cents on Wednesday. So let's have a look at Trading View. Let's just check out and see how the market is going here in Australia right now. The dollar is up 67.56, not much. And what can we do? SX 200. How are we sitting with the data with the 4-hour trend? Oh, there you go. So yeah, it's come down a bit. We'll have to see how it goes throughout the day. Let's check it for the month. So yeah, I mean, one to watch. So, and we'll skip over there. The losses come a day after stocks rallied when the Trump administration delayed tariffs on about $160 billion in Chinese goods that were set to take effect on September 1. Mr. Trump took to Twitter to defend his trade policy Wednesday, saying, "We are winning big time against China." Seems like he's backed down, doesn't it? But many on Wall Street remain worried that the trade war between the world's two largest economies may drag on through the 2020 US election and cause more economic damage. "We still see a substantial risk that the trade dispute will escalate further," said Mark Hafele, Global Chief Investment Officer at investment bank UBS, in a note to clients. Mr. Trump also criticized the Federal Reserve for hamstringing the US economy by raising rates too much and too fast last year and not revising its policy aggressively enough. The Fed cut its key rate by a quarter point last month. Well, at least they have room to move. At least they have room to move in the States. Australia, we've got nothing. What have we got? 1%? New Zealand just cut it by 50 basis points. So companies and jobs are fleeing. Prices to us have not gone up, and in some cases have come down. China is not our problem. The Hong Kong is not helping. Our problem is with the Fed. Raise too much and too fast. Now too slow to cut, he tweeted. Spending is way too much as other countries say thank you to clueless Jay Powell's and Federal Reserve. Germany and many others are playing the game. Crazy inverted yield curve. We should easily be reaping big rewards and gains, but the Fed is holding us back. We will win. I mean, that's typical Trump, marketing strategies. So we've already read about what the yield curve is, and it's going to be interesting, guys. So what do you think? Do you think this is a sign that we're now on a countdown to 15 months to a recession? Why are people investing in negative return bonds? Negative yield bonds, why? Why are they doing that? Do you think it's just a sign of how concerned people are for the future and they have to park their money somewhere? Let me know what you think, guys. Like, share and subscribe, and I will see you all again later. Take care.